can you identify areas where demand and supply are really matching in a perfect, most efficient way, right? And that's where really the magic happens, because buyer demand meets kind of the supply that's on the marketplace. And that could be in certain areas, price ranges, certain ages of buyers, certain geography of buyers or sellers. So really trying to understand where does that marketplace work particularly well. And that's what we call kind of hotspots in a marketplace.
Is this thing on?
Yesterday's price is not today's price.
Thank you, Fat Joe, and welcome to Run the Numbers, where I interview world-class CFOs, operators, and the investors who fund them on how to get the most out of your company's performance. This podcast is a playbook of sorts for ambitious people in the worlds of finance, strategy, and operations. Today, my guest is Boris Wertz, the founding partner at Version 1 Ventures. Boris began as a founder and operator selling AbeBooks, a marketplace for out-of-print and rare books, to Amazon during the dot-com boom. He then went on to start his own VC firm where he invests in marketplaces. He's had some notable wins in Coinbase, Shippo, Uniswap, Outreach, and Jobber. On this episode, we cover focusing on a core niche when you start a marketplace and avoiding the temptation to go broad, ways to crack the chicken or the egg problem, why having the mindshare of the buyer is now more important than just owning the underlying supply, what inning we are in when it comes to marketplace innovation, comparing the financial profiles of marketplace models versus typical horizontal SaaS models, finding a balance between purchase frequency and purchase size, and how marketplaces have limited exit opportunities compared to other business models in technology. This interview was special for me, as I read a lot of Boris and Version 1's materials when I was trying to start my own marketplace back in the day. Boris has seen 3 waves of marketplace models evolve over time. First, starting with the shift of selling tangible products online to offline in the early 2000s, then the shift to selling services with the rise of mobile in the 2010s, and now the shift to fully managed marketplace which leverage AI in the 2020s. For all those obsessed with companies who rely upon network effects to be successful, this one has it all. The past, present, and future of marketplace models. All this and much, much more after a short word from our sponsors. Quick math, the less your business spends on operations, on multiple systems, on delivering your product or service, the more margin you have and the more money you keep. That's the goal, isn't it? But with higher expenses on materials, employees, distribution, and borrowing, everything costs more. Yesterday's price is not today's price. So to reduce costs and headaches, smart businesses are graduating to NetSuite by Oracle. NetSuite is the #1 cloud financial system, bringing accounting, financial management, inventory, HR into one platform and one source of truth. With NetSuite, you reduce IT costs because NetSuite lives in the cloud with no hardware required. Access from anywhere. You cut the cost of maintaining multiple systems because you've got one unified business management suite. You improve efficiency by bringing all your major business processes into one platform, slashing manual tasks and errors. Over 37,000 companies, wow, that's a lot of customers, have already made the move. So do the math. See how you'll profit with NetSuite. And back by popular demand, NetSuite has extended its one-of-a-kind flexible financing program for a few more weeks. Head to netsuite.com/metrics. That is netsuite.com/metrics. Ooh, yeah, you know your boy loves some metrics. That's netsuite.com/metrics. Please do it, guys. I really need this. Cash is king. As the CFO of a SaaS company, I know firsthand how important it is to maintain a healthy AR balance. If you can't effectively manage cash, you can't service debt, make payroll, or invest in growing your business. That's why I'm so excited to partner with the sponsor of today's episode, Maxio, the leading billing and financial operations platform for B2B SaaS. Maxio helps top SaaS companies like Chili Piper, Crunchbase, and Stack Overflow get cash in the door faster by automating collections and dunning. Gone are the days of manually chasing down invoices. Join the 2,500 plus subscription businesses using Maxio, formerly SaaS Optics and Chargeify, to eliminate revenue leakage and streamline order to cash. It's never been easier to get paid. Visit maxio.com/run the numbers to supercharge your financial operations in 2024. Not only does requesting a demo using the Run the Numbers link help support this podcast, ya boy, you also receive a 10% discount on your first year with Maxio. Woo! That's maxio.com/run the numbers. That's maxio.com/run Run the Numbers. Boris, welcome to the Run the Numbers podcast. Thanks for joining me.
Hey, thanks for having me. Very excited to be here.
One of the reasons I've been excited to talk to you is you're both a former marketplace operator and an investor. And so I first discovered you probably 5 years ago. So me and my wife were starting a marketplace. It was a last minute tour and activity marketplace. And we were trying to figure out like how these business models actually work. So I came from the enterprise software world. She came from a pricing consultancy. And marketplace models, I think people sometimes get sucked in because at first you think it's easier. Like, oh, you don't actually have to own the thing. Like you can, use someone else's supply and inventory. But it's actually, you're like jumping out of a plane and trying to build a parachute on the way down. And so version 1, where you work, has some amazing content out there. I encourage people to take a look at it. I'll link to it in the show notes. But I just wanted to say thanks for helping me through a time where I had no idea what I was doing.
That's a great story to start this conversation with. We launched our guide to marketplaces, I think somewhere 8 years ago. And at the time, we just felt like there was kind of a hole in the market. Not many people were really writing about marketplaces, sharing their insights. And as you say, it's a very unique business model, very unique way how you need to kind of build and scale these marketplaces. And that guide to marketplace got an incredible reception over the years. I think it has been downloaded over 100,000 times by now.
Wow.
So looks like there's lots of marketplace entrepreneurs and operators out there that got their value from that.
Yeah, and it still helps me today. So that business didn't work out. I think we ran into the LTV to CAC trap, which we'll go over on this podcast, but it kind of came full circle. I'm a CFO at a marketplace business now, and a lot of the concepts that you discussed in those docs and in those guides still help me today. What I did want to get into at first is your time as an operator. So I want to go back to the start, pre-investor days. And you started Just Books back in 1999. That was a cool time frame. I'll just put that to the side because there's a lot to go over there. And it was for used and out of print books. And you sold that to AbeBooks, and then you jumped aboard at AbeBooks and helped sell that to Amazon. And focusing on out of print niche books might appear overly specific to some people. How did you possibly stay disciplined to win in a niche and not go too broad?
Yeah, I mean, great reminder that kind of starting AbeBooks is now almost 25 years ago. Right? So it's crazy how time flies. Internet 1.0, and there was obviously lots of excitement back in the days, lots of white space that you could build in. Every single category could be invented. And I remember at the time, people really kind of almost laughed a little bit about us and say like, wow, you're going after this really niche business. You should kind of have much bigger ambition. Turns out that what we did was really bring a completely offline, inefficient market online, right? And make these hard to find books that were all literally stored in hundreds, thousands of bookstores around the world into a big global database that was suddenly accessible by buyers from around the world. And, ultimately it really was a truly internet native business model, right? There was something that was really hard to find, really hard to access, that was suddenly be made very readily accessible for anyone that was interested in that, right? We obviously tried to expand over the years into other areas. Also realized that by then, kind of new books had been dominated by Amazon. But we were really extremely good at protecting our niche of used, rare, and out-of-print books.
Did you start with a list of different things that you wanted to tackle as a business, and you kind of went through and said, this one seems like it has the most, room to run? Or how did you stumble upon going after this category? And maybe it was something you were passionate about, so it wasn't stumbling at all.
Yeah, so I think was two things. I mean, we were students at the time, and so we understood kind of how hard it was to get used textbooks, and kind of have a liquid market around that. So that was the personal experience. But also top down, we thought about kind of what is an interesting category where the internet really provides tremendous amount of value. Right? And so I think it was both like bottoms up personal experiences as students, as well as kind of looking at that category top down and thinking that was really interesting as a vertical to go after.
That's a great takeaway, that you have to go both bottoms up, and it should probably be from some position of like experience of knowing the pain, uniquely knowing the pain, and then tops down of saying like, is this actually like a venture backable, if you wanted it to be venture backable, target addressable market that we could go after. The word out of print books just makes me think of scarcity. So how did you possibly get the marketplace off the ground when you think about cracking the chicken or the egg problem?
Yeah, I mean, it was a bunch of things we did, and it was very, very much bootstrappy and just generally kind of trying out lots of things. So the first thing we did, we bought our own inventory, right? You said like we had to, at least when we launched, had some inventory on there. And when you called up bookstores at the time, they weren't really interested in giving you the inventory. We had like no website at the time. It was pre-launch. And so from that point of view, we needed to do something, right? So we bought our own inventory and basically bootstrapped it that way. After that, we kind of went after every single bookstore that we could get hold of. The biggest challenge at the time was like most of that inventory was not digital. Like most of the stores had like literally offline inventory. They didn't even know what they had in their store. Perhaps some had some catalogs in a Word document, but that was obviously not compatible with the database. So what we tried to do over time is make it just super easy for these bookstores to either create a catalog of their books or convert the existing Word catalog into a database, and just reduce the friction of onboarding supply into our marketplace. And then the rest was literally just hustle, calling them over and over again, meeting them, and removing the friction between kind of their offline inventory and getting that into our database.
I want to drill into the data piece here. Was there any sort of data standardization or maybe a coding that people used in the industry that you could base it on? And I ask because I imagine that this totally sucked to pull together, but it maybe became a competitive moat over time, that you had gone through those pains.
Yeah, I mean, so originally there was nothing, literally nothing, right? I mean, today you would have so many tools, small databases, you'd kind of catalog your books in. What we tried to do is actually set the standard. So we started to think about, and we actually started developing a software that would help people to catalog their books. Back in the days, it had to be a desktop software. Like it didn't yet work in the cloud, so it was much more complicated. Today, it would be so much easier, just to build it on top of Excel or Google Sheets or something like that, or Airtable, whatever it is. But at the time, like you really had to kind of build your own software. But the idea was certainly, as you just said, like standardize the data, make it super easy for people to catalog their books and get a competitive mode in that area. That is all. Like these days, supply is super liquid in that market, and there's no moat anymore around that. But back in the days, it certainly was a moat.
Do you recall any instances of doing things that didn't scale? Like, did you ever find yourself in like the basement of a dusty bookstore, like trying to help them get inventory online or anything like that?
Yeah, I mean, listen, that was all of the work in the first 1 or 2 years, right? It was literally, I mean, from buying our own inventory and in kind of cataloging ourselves, like literally uploading it to helping other booksellers to do that, to literally taking Word files, right, that we got, Word documents with list of books, and converting that into writing conversion programs to get that into our database. I mean, like all of these things like didn't really scale, but there wasn't any other way to kind of get this off the ground. And I think every single marketplace, when they start doing that, kind of start off, needs to do these things, right? Things that don't scale.
And the other thing, besides the data cataloging piece that just caught my eye, is you said that you bought your own inventory. That seems like a pretty cool hack if you have the means to do so. I think you see that marketplaces are kind of skewing towards that nowadays, where they're actually like a full service. Like they say it's a marketplace, but it's really only just one side to it.
Yeah, I mean, listen, you have to be a little careful and evaluate how much that actually scales. In our case, it really didn't scale because, I mean, you look at AbeBooks today, it has like over 100 million books in inventory, right? And how many books can you buy yourself? Like, thousands, and catalog that. And plus then you have to take care of shipping later on. So it's not only just like the buying in the beginning, there's a lot of operational complexity down the road. So I think in our case, it didn't really work. I think it's a little easier when you have a marketplace where you need very little supply to make it functioning. So when you think about a marketplace for virtual doctor appointments, right? In the beginning, you don't need to rely on doctors from all the world joining the marketplace. You can hire 3 or 4 and you have inventory for the first phase of the marketplace, right? So especially in the services area, you need way less supply.
That's a good point.
And so obviously you can take that on. That's a little bit different if you're in the long tail of products marketplaces like we were at AbeBooks.
Would you mind just breaking down for listeners like what it means to be in the long tail versus like the example you gave with service, where I guess like a widget's a widget and like that doctor could see you for everything?
Yeah, I mean, listen, we always think about when we evaluate marketplace as investors, right, is how differentiated, unique the supply is versus how concentrated it is, right? And so obviously anything that is and when you take the product side, anything that is used is obviously much more unique than anything that is new. New, like a new book is a new book, while and it's usually offered at the same price. A used book could be in different conditions, at different prices, in different locations, etc. So it becomes like a very unique book. The same thing on services. Some of the services, as we just said, like, a marketplace of doctors, you like every doctor can most of the time deliver the same service. But you look at it because it's ultimately geographic agnostic. But if you have a services marketplace where the service is delivered in a certain geographic area, let's say home services, right? Obviously, the plumber you just onboarded in Kansas City can't really take care of a plumbing job based in Miami. So you always have to think about like how much supply do you actually need to build the marketplace, and that is along the uniqueness of the product and the service and the geography.
Yeah. The story of AbeBooks and the inventory and the long tail play that you went after, I've always thought it kind of reminded me of another marketplace that I use. It's called Discogs, and I can buy vinyls. So like if people are watching the video version of the podcast, you can see a vinyl behind me, and I have a bunch of them. But in the back of my mind, I've always been like, that must have been tough to get off the ground because you don't really know which obscure vinyl that I'm looking for, like like a random Young Jeezy album from 2007, something like that. So I've come to appreciate these long tail models because you can see why it would be way more attractive for someone who's a buyer, but you can also see how the challenge would be even taller for someone who's trying to bring that supply online.
Yeah, I mean that's exactly that trade-off, right? You have on the one hand side, it's harder to build, but then it's also more defensible because you create more value, and it's much harder for anybody else to rebuild that as well.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Okay, serious question for all my accounting pros here today. Are you doing what you were hired to do? What I mean is, do you have time to actually be a business partner, or are you buried in tedious manual tasks just to get your journal entries prepared every month? I know how that feels. Leapfin's here to help with that. Leapfin is accounting automation software that automatically prepares and posts reliable journal entries. And that's just the beginning. High-growth businesses like Reddit, Canva, and Seat Geek choose Leapfin to eliminate manual tasks, accelerate month-end close, and enable accounting leaders like you to provide faster insights that will help your company grow. If you're battling messy transaction data from Stripe, Adyen, Shopify, Apple Pay, and other PSPs, and then battling again to get it all into NetSuite, go to leapfin.com to watch their short product intro video. And if you like what you see, request a 15-minute conversation to learn how accounting automation can help you and your team. Check out leapfin.com today That's leap like jump, fin like shark. I just made that up. I hope they're okay with it. Leapfin.com. Mercury knows your financial operations are complex. Founders and finance teams have to pull together different tools, reconcile transactions from different sources, and struggle to get accurate answers. With Mercury, you can simplify your operations with banking and software that power your critical financial workflows, all within the one thing every business needs, a bank account. And with new bill pay and accounting capabilities, you can pay bills faster, stay in control of company spend, and speed up reconciliation. Apply in minutes at Mercury.com and join over 200,000, ambitious startups that trust Mercury to provide the precision, control, and focus they need to transform their financial workflows so they can perform at their best. Mercury, the art of simplified finances. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Bank and Trust. Members FDIC. I'm getting good at that voice. I want to transition to talk a bit about changes in marketplace dynamics, and you led me perfectly into that because I once heard you say, Boris, that having the mindshare, the buyer, is now more prioritized than owning the supply. Can you unpack that a little bit?
Yeah, I think two things. I mean, I think it's happening both on a individual marketplace level as well as across the industry. And so let me explain. I think in the beginning, any marketplace that is starting to evolve, right, it's built around supply. And if you don't have the supply, you don't even have a marketplace, right? And so you really need to kind of start there. But as the category grows, sellers on that marketplace will look for other opportunities to sell their inventory, sell their products, sell their services. There's no reason for them to just stay on that marketplace. And other competitors will come in and really look at onboarding these sellers as well. So supply doesn't stay unique to your marketplace. It really moves into other categories, into other marketplaces. And so then it becomes just incredibly important, if supply is not unique to you, that you have the buyer's mindshare, right? And that really only happens if you have a product suite and product offering that is large enough, that is broad enough, so people really stay top of mind for you, for your purchases, right? And they usually go where kind of that mind share is. So I give you two concrete examples. So for AbeBooks, started in used rare out of print books, right? Always had the mind share there. But then we tried to get into new books as well. But Amazon already had the mind share of these new books purchases, right? And at the same time, Amazon really expanded their inventory in used rare out of print books, right? And so ultimately, Amazon became, as we all know, the everything store, right? Had incredible mindshare among buyers, and lots of people over time that perhaps would have kind of looked out for and searched out AbeBooks, kind of decided that I can find the same books at Amazon. I'm already here for many other reasons, for many other products, etc. I'm not going to go there, right? The similar thing is, look at what happened with Uber and Lyft, right, in the services category, right? They both started out in the same area of kind of private ride sharing. But then Uber really expanded across many different categories, many different products within ride sharing, and kind of the Uber X and the premium, the comfort, etc. Then added Uber Eats on top of it, etc. And became just a much larger app in terms of the exposure that they had, the coverage that they had, right? While Lyft stayed kind of much smaller and much more focused, right? And so I think every single marketplace is kind of evolving like that over time, that they start with very unique supply, then supply becomes kind of liquid across many other marketplaces. And then what ultimately matters is that the buyer awareness, the buyer mindshare.
And the buyer mindshare, that's when I'm standing on a street corner in Boston and I pull up my phone and I search for or click on the Uber app just out of habit.
Exactly.
Is that what you mean?
Or you consider Amazon, if you think about buying any product, right? You're probably going to look on Amazon first, right? Versus looking somewhere else, right? And then ultimately, I think most people have probably 4 or 5 apps that do most of their jobs for you,
right.
For them, right? And only in the case that these apps can't do the job, then you look somewhere else, right? But ultimately, you become very focused on a few apps that drive most of your activity.
That's so fascinating that after supply becomes liquid, it's how much does the buyer think of you? And I've heard just anecdotally that in, say, Asian cultures, it's like more normal to have an app that does way more things than in US cultures. And I've heard Elon wants to create, an everything app eventually, where like maybe it starts, top of funnel by getting people through a social network, but eventually you're buying things through there.
Yeah, correct.
How have marketplaces shifted from simple product transactions to more complex services over the last 20 years? You brought up Uber and how it's more services. It's not just a rideshare. I mean, you can get a burger delivered to you. But can you talk about if marketplaces are taking on more of an active role these days with the services they provide?
Yeah, I mean, so I think there's two things that happened over the years. I mean, the first one is obviously people got more comfortable buying more expensive items or doing more expensive transactions over marketplaces, right? In the beginning, you were okay potentially losing $10 buying something on eBay because the seller never shipped it to you, or it was like a damaged item or something like that, right? But as people saw that, hey, these marketplaces work, it's okay to buy from somebody or get a service from somebody that I didn't even know before, they got more comfortable doing more expensive transactions. The second thing is like they also got more comfortable doing transactions with things that are perhaps less explicitly described, like a service, right? And I think over time, this was enabled by a few things. I mean, first of all, marketplaces have done a really good job of standardizing services. So let's say like almost like an SKU, like a kind of a unique product identifier, like really standardizing it. And before there was much more variability in services and people trying to really kind of standardize that around a service expectation, right? The second thing is marketplaces have done a really good job in a combination of reviews and kind of guarantees and just service level promises to really make sure that buyers are comfortable that they chose the right service provider. Secondly, if something goes wrong, the marketplace is in the corner to kind of fix it. And then last but not least, I think marketplaces have just become much more managed, right? Where certain aspects are part of a marketplace and you don't have to figure them out anymore. For example, that could be standard pricing, that could be obviously taking the payments, et cetera, right? And so I think just to expand marketplaces, you just have to go in all of these different directions to drive up transaction value, to drive up kind of non-commoditized transactions that weren't really part of marketplace before.
Okay, now we're cooking. There's a lot to dig into here. So I half joke that, my wife is like trying to buy us our next house online, but like people actually do that now. So we had a second kid and we need another room now. And so we've been looking at houses and we actually almost made a offer and purchased a house online without looking at it. Like we sent her parents and stuff. So it wasn't like a completely online transaction, but it did have this like aha moment in my head that like, I'm actually a lot closer to buying like a house, the largest, transaction of my life online now. And you actually see it with, the different real estate marketplaces. Like I think it's Open Door is moving that way and they own the supply, but more expensive items coming online. And Boris, we talked to Jack Greco, the founder of ACV Auctions, and he had described how it was kind of this monumental shift where they were in the right place at the right time, that people were like finally willing to buy a car, like a 4,000 pound heap of metal that's thousands of dollars online for the first time. And he said 5 years ago, I don't think we would have been in that spot to have buyers lean in.
Yeah, I think it's a natural trend that, well, let's put it that way. The verticals where we still have a pretty large offline share, right, are usually dominated by brokers. In this case, real estate agents for real estate, right, that provide certain services, but also just a certain level of security and trust for somebody that engages in a real estate transactions every whatever decade or 2 decades, once in a lifetime, right?
And I'm not in the market that often.
Obviously, the combination of a high ticket item, right, a complex transaction, and doing it on a very irregular basis, potentially on, in this case, also like first time basis, right? You love to rely on somebody that is an expert, and you pay quite a bit for that service, right? I mean, like real estate commissions are obviously pretty high. I think over time people will get more comfortable replacing those brokers, those real estate agents in this particular case, with marketplaces that can provide most of the services, and they're always going to be kind of a carve out for real estate agents that kind of can play on that trust and continue to play on the trust, right? But in general, I think it's going to be much more transparency to this marketplace through tech solutions, and marketplaces just replace kind of the in-person broker.
Totally. And another thing that you mentioned was the services element. And I look at marketplaces, and Dan Hockenmeyer, who's the head of strategy at Fair, wrote about this, and he had previously worked at Thumbtack, so he saw it firsthand, is that there does seem to be this evolution where like we started with physical things, like I'll ship you a book, and now it's like you can buy a service that's kind of ambiguous in nature. Like I need a plumber, it's like, or an electrician, but what job are they going to do? And people are a lot more comfortable with getting something that's not really a cookie cutter item. It has to be bespoke to whatever they kind of need.
Yeah, correct. I mean, to our point before, kind of standardization is entering the industry, and that enables much more of these scalable marketplaces to flourish.
Yeah. And you see it with the rise of like the Fivers of the world. Like you can literally find somebody to do anything now, where 10 years ago maybe you were just getting to the point where you could find any book you wanted, but now you can find somebody to, I don't know, be a clown at your kid's birthday party or blow up balloons. So we've come a long way.
Agreed.
What inning do you think we are in marketplace evolution today? You've seen a couple different cycles here. I mean, you helped build one of the first ones, and now you're investing at the forefront of it. So where do you think we are within kind of the development life cycle of where marketplaces are going?
So marketplaces, I think of them always as moving along with where technology is, right? And kind of what people are developing at the edges of technology, right? And so originally, when you think about marketplace development, the first generation was very much focused on product marketplaces like eBay, AbeBooks, etc. The second generation was very much focused around services marketplaces, partly enabled through mobile. We talked about Uber and Lyft. I think right now we're seeing lots of marketplaces being developed in crypto and blockchain, right? Because ultimately, blockchain enables trustless trading of financial values and assets. And there's lots of marketplaces being built on top of blockchain, and it kind of enables a completely new class of marketplaces that people don't even think so much as marketplaces because it's outside of the original definition. You see lots of new marketplaces developing around climate solutions, right? Carbon offsets, for example, tons of marketplaces, financing solutions that bring together clean tech investors and people looking for clean tech investment. So I really think that marketplaces, like the core principle of organizing buyers and sellers in a scalable way and bringing them together through technology, is only going to get more important than less important, right? But the real opportunity is the real white space is just at the edges of new technologies, right, that get interesting. Last example, everybody's talking about AI. There's actually a bunch of really interesting marketplaces that are now developing around AI. For example, kind of the Airbnb for AI compute power, things like that are super interesting. So people might not really think about that in that way, but at the edges, there's many new marketplace models evolving, and just the underlying model is just such a strong, interesting one. We're always going to have that. So wherever that inning is, but it feels like certainly rather earlier than later.
So the first inning was, I guess, the catalyst was the internet, offline to online. Second one, I love that you mentioned that services came around because now we have mobile enabled services. What do you think is the main catalyst today that is driving this new wave? Or asked it maybe a better way, which catalyst are you most excited about? You mentioned AI, you mentioned blockchain. How do you think about it?
I would say blockchain and crypto is just generally, it's like, I think the biggest opportunity, just because we're talking about the financial industry, right? So give you one example. One of our portfolio companies is a decentralized exchange called Uniswap, right? Where anyone can buy or sell a token, right? And they just had $2 trillion in a lifetime exchange volume, right? So incredible amount of tokens being traded in a little bit less than 4 short years, right? And so you just look at the amount of liquidity and trading that is going on in financial markets, right? Obviously, we see in the stock market on a daily basis, but if all of that between currency trading and stock trading and options trading and so on, if all of that moves to the blockchain and creates these highly liquid marketplaces, right? Then obviously that's a gigantic opportunity that kind of will trump anything what you see in the physical world, for sure.
That was a good example. I want to drill into metrics. So I'm a metrics dork. How should metrics evolve in early stage startups, kind of where you start in your investing life cycle? So for example, the difference in a company searching just for product market fit at the start versus once they get to consistently monetizing and getting to profitability. How do those metrics shift over time for a marketplace?
Yeah, I think in the beginning, anything that really matters is around understanding product market fit, right? And that will literally mean what is the liquidity on the marketplace in a certain category, and how is that liquidity met with buyer demand, right? And so it's like these liquidity ratios are incredibly important, and is demand meeting supply, and is there a match, right? After that, as you scale, then the question is much more about kind of how do you acquire users, how do you monetize users, and how do you retain them, and kind of the real economics of that. And then after that, it will be much more about actually expanding beyond the core to other areas and kind of seeing if you can really get a flywheel going. So it really starts on a very small core level, right, of a marketplace, and then expands from there.
Can you break down liquidity ratios for the benefit of listeners? How do those work?
Yeah. So there's two things I think that is important to understand. I mean, the first one is like just liquidity in a marketplace is if I come to a marketplace as a buyer, right? What is the amount of different products and or service offerings that I can find, right? So on AbeBooks, it would be kind of out of the universe of books that are out of print, how many of those do I find on AbeBooks? And then sometimes it might be even important that I have different copies for each unique book at different price levels, different condition levels, etc. On a services marketplace like Uber is like literally how quickly can a car that I need today, right now, kind of pick me up? Does that take 2 minutes or 10 minutes? And kind of what is the liquidity in that marketplace, right? And so the more liquidity you have, the better, right? Obviously, but you also need to kind of make sure that liquidity kind of is corresponding to demand, right? Could be that AbeBooks has like the greatest liquidity of out of print books, but there's nobody looking for out of print books on AbeBooks, or like it's really deep liquidity in this one area, but everybody's looking in a different area, right? And so the first question is really how deep and broadly diversified is your liquidity, and secondly, how does it match up to demand? And so that's what we call kind of a concept called hotspots, right? Where when we look at a marketplace, can you identify areas where demand and supply are really matching in a perfect, most efficient way, right? And that's where really the magic happens, because buyer demand meets kind of the supply that's on the marketplace. And that could be in certain areas, price ranges, certain ages of buyers, certain geography of buyers or sellers. So really trying to understand where does that marketplace work particularly well. And that's what we call kind of hotspots in a marketplace.
Thanks for breaking that down for us. What me and my wife struggled with when we were trying to create the last minute torn activity marketplace is that you had to have sufficient liquidity within each geography. And it's really hyper local. So like St. Pete Beach in Florida has to have a different liquidity ratio than Tampa, Florida, than Naples, Florida. And so you realize that you need to have these white hot centers or hot spots for all the different product offerings, and even more so if it's a service-based marketplace.
Yeah, correct. That's the nice thing about most product-focused marketplaces are geographically agnostic, because you can send a product almost anywhere, right? I mean, might be a cost difference, but otherwise, like it's not. While services are usually pretty limited to a certain geography, so much tougher to scale these. Because the supply is much more concentrated in a certain geography.
Yeah. As someone who's been on the finance side of the house for both SaaS companies and for marketplaces, I've always been fascinated by the differences between the models, where one is more efficient than the other. Do you have any observations on where marketplaces may be either more or less efficient than the unit economics of a typical SaaS model?
Yeah, so marketplaces are very hard to start, as we just discussed, figuring out the chicken egg problem. Once they really work, right, and you have a unique positioning, they can scale very, very easily, right? I think there was a phase at AbeBooks where we felt we didn't even have to do much. Like literally, buyers and sellers just came in, magically kind of used the product, and it was just scaling on its own. Right, just because it was a unique product and network effect kicked in. So it's in the beginning very hard, right? In the end, it can get really, really easy as network effects kicked in. And you've seen that through Etsy or eBay or Airbnb and you name it, Uber. SaaS companies are much more linear in terms of the growth. There's not many network effects, but it's also a little clearer how to build them, right? The chicken and egg problem is not that hard. You have to build a great product and then start acquiring users that might kind of buy that product, right? So I always think about that. It's much more predictable, but it's also much more linear in its growth. Marketplace is way less predictable if you ever gonna get them off the ground. But if they work like charm. I think the biggest challenge as investing in marketplaces is there's very few exit opportunities for small marketplaces, right? If you run a marketplace that has 10 or 20 million in gross merchandise value, there's very few people that would buy that marketplace, right? That's a little bit different in the SaaS category. If you have 10 or 20 million dollars in revenues, there's probably a larger company that's going to acquire you for a product feature, or somebody is doing a roll-up, etc. So marketplaces, to really provide a return for investors, need to grow really, really large and ideally go public, right? And there's obviously very few ones that are in that field.
And do you think that's because of the take rate dynamic, that maybe it's just a different math equation that people look at from the outside in, or why wouldn't someone want to gobble up a marketplace that's doing, say, 20 million in GMV? Does it cost more to keep it going?
Yeah, I think that's exactly the case. Like, I think in a SaaS product, you would integrate that product into a product suite and just sell it against it. There's very little,
easier to roll up.
There's very little synergies between different marketplaces. I mean, usually, kind of, you couldn't really have many synergies on the seller side, not much on a buyer side, right? So there's just very few synergies.
We've had a lot of marketplace chats with experts, and no one's brought up the exit path. I never thought about that the synergies are fewer, but they probably are even more powerful when you do get one right. I've always thought, like, would there ever be an opportunity where Uber and Lyft just combine, make one massive ride sharing business? Yeah,
but at the same time, if you were Uber, you probably are not really interested, because now that they have a superior product, right? more liquidity, they're just probably going to eat slowly but surely into the market share of Lyft in different geographical markets, right? And over time, there comes a kind of a flipping where the Lyft supply in some markets might just not be enough anymore. It might not be interesting, right? Because you have to wait for whatever 10 minutes to get a Lyft versus 3 minutes for an Uber, and then it's probably game over for a Lyft in those markets.
To get a bit more specific on metrics and talking about SaaS business models versus marketplaces, I often think about LTV to CAC, so lifetime value to customer acquisition cost. In a typical SaaS model, I think it actually gets harder over time to acquire the next incremental customer. Would you say with marketplaces, it's kind of a reverse dynamic?
Yeah, I mean, if you have network effects kicking in, right, and again, not every marketplace is ever going to get to that point. I think you need to have, for network effects kicking in, you need to have continue to have unique supply. Secondly, have buyers that come back on a very repeat basis, right? Because if you have a marketplace that literally you're only going to use every 10 years, right, for a transaction, you're never going to get any significant network effects, right? And so there's very few marketplaces that can actually have these network effects kick in. But if that is the case, then obviously your CAC only going to get smaller and LTV going to get higher. So these are kind of beautiful models, right? But lots of marketplaces never really hit that because the underlying transactions are too infrequent, and people just then forget about your marketplace. So you have to reacquire the user the next time they're looking for a solution in your vertical.
At the risk of going off on a tangent, you quickly touched on when AbeBooks hit that product market fit point where like people were just showing up and doing transactions. What did that feel like? Do you remember what you were saying to the other people you were working with?
Yeah, I mean, listen, it sounds just so magical. Like you literally don't do much and the business is growing, right? And like very few businesses have that. I mean, like a SaaS business, you feel like you continuously have to block and tackle and kind of push forward.
Oh, you're pushing the boulder up the hill constantly.
Yeah, and there's nobody coming and just doing that automatically, right? And so it just felt like a magic moment. Again, given the competitive nature of marketplaces and the internet in general, that won't last for too long because, kind of as I said before, lots of our competitors starting to kind of get our supply. So our supply was getting less and less unique. And, Amazon was obviously one of the toughest competitors for us that was pushing in that area. So you know that this moment can't last for forever, but you have a moment where that is amazing, and you kind of feel like just network effects just pushing you forward without any hard work from your end.
Yeah, product market fit is one of those things that's hard to quantify, but I guess you just know it when you have it.
Correct. Yeah.
To get back to the regularly scheduled program, are there any metrics that you focus on as a marketplace investor more so than a horizontal tech investor? Like an example, I guess, would be like maybe like take rate.
Yeah, I mean, I think the take rate is just a super important thing over time, just like how big of a marketplace or kind of a marketplace business can you build, right? And obviously it depends on the take rate. And kind of a take rate is very tough to keep at a elevated level if buyers and sellers are concentrated, right? So it's much easier to kind of have a high take rate if there's literally millions of buyers and millions of sellers, right? And you match them every single time they come to the marketplace. Uber is a great example for that, right? I'm not going to negotiate individually with a taxi driver, but I'm going to just take the Uber app to do so, right? And so there's lots of marketplaces out there that have underlying a very large opportunity, but there will be never any real opportunity to charge a large take rate, right? And so if you can only charge 0.5% or 1% because you have a lot of enterprise buyers and sellers, on there, then it's going to be hard to build a really large marketplace business. You have to build a gigantic underlying gross merchandise volume business to get to any reasonable number. So take rate is definitely something we look at. And, it's everything from, I think at the low end, you literally have like a percentage point. And at the high end, some marketplaces are capable of charging 20, 25%. Amazon, when you look at Amazon Marketplace, is like probably in the 35 to 40% if you include all of the fees, from transaction fees to payment fees to shipping to fulfillment that they force you to use it. So, some of these marketplace businesses are very, very profitable in terms of take rate.
As an advisor to companies that you invest in, Boris, do you ever tell them to actually lower their take rate?
Yeah, so first of all, you always want to make sure that you're delivering actually the real value for that take rate, right? And there's tons of companies where people would say like it's just outrageous what they charge, right? I think lots of people have mentioned Shutterstock as an example where they literally charge like an crazy amount.
Yeah.
And that obviously, as Jeff Bezos always says, like your margin is my opportunity, right? Like that will just encourage competitors to go after you, right? And so I think you want to be fair to the marketplace and charge appropriately to the value you're creating for that marketplace, for that industry, and not be too greedy, right? And so that might be that you're reducing take rates over time, or you're just adding more value to the marketplace. I think both of these things kind of might be strategies you should look at.
When you're sizing up a potential investment and you're thinking about, hey, this is the take rate as one lever, and this is the frequency of transactions as the other one, and then I guess the third lever would actually be the average selling price. Which of those three do you think is the most important one to really drill into?
I think it's really the frequency of the transactions, right? Because I think it becomes so much tougher as a whole business, right? To build something sustainable if you have to reacquire customers all the time. And so I'm just a big fan of marketplaces that continue to deliver value to customers and have an underlying purchase frequency that makes people to come back all the time, right? That's really where it all starts. And when you have that, then you're obviously going to see average value of the transaction go up. You're obviously going to be able to increase your take rate or charge a take rate that is adequate, just because you're delivering value for these customers and they come back all the time, right? And as discussed before, frequency transaction is really also the unlock for network effects, right? If you don't have that, then you don't have network effects, and you still can obviously run a really good business, but it's going to be much harder, and it certainly doesn't enjoy the marketplace dynamics that we discussed before.
Can you think of any companies that, like, if you were to envision a quadrant, who would be in like the Goldilocks zone of having both high frequency and high price? Because I think of maybe in, I don't know, Grubhub, that's high frequency, but maybe you're only delivering a $15 cheeseburger. I guess maybe, what do you think?
Nobody comes to mind that has like high frequency and high price. It's just the matter of kind of most of the things we use on a high frequency basis probably are day-to-day products or services, right? That are, kind of, I don't know, in the, dozens, perhaps low hundreds, right? But generally, I would say this is kind of the sweet spot. Kind of you think about the DoorDash, Grubhub, Uber, Amazon Marketplace products, Etsy, kind of you name it. There's a bunch of them. I think probably the only one that I would kind of put in there, perhaps now that I think about it, is Airbnb. It's not as high frequency, but obviously Airbnb has like having expanded kind of the product suite and offering for a subsegment of customers, like people that are kind of these digital nomads that travel around the world. Yeah, I'm pretty sure there's like probably tens of thousands, if not hundreds of thousands of people that use Airbnb 5, 6, 8 times a year, right? And actually spend quite a bit on that marketplace, like, literally thousands of dollars per stay, right? So that could be perhaps an example where, at least for a subsegment of people, traveling around the world and working from all sorts of remote locations. They use Airbnb in a frequent way, but with very high ASPs.
The one that I came up with was either a StockX or a Goat for shoes. So I'm a sneakerhead, and so I probably buy a pair every other month. But if it's a $300 pair and you're doing it 6 times a year, that's a pretty high ticket price and relatively high frequency. Yeah,
that's a great point. Those like collectible sites where kind of frequent collectors are purchasing all the time. Yeah.
So maybe gearing towards a close, I'll just hit you with a couple questions about your observations from your years investing in these types of business models. And so if I look at early stage investing, you're essentially taking a bet on a special type of entrepreneur in an interesting market. Mm-hmm. What's a good hit rate look like when you think about returns? How do you think about your upside and downside there?
Yeah, I mean, listen, like the model in venture always is like a third of the companies will just close down and be a zero, right? A third of the companies perhaps pays back the money you invested, and then all the returns come from the rest, right? The other third, and even out of that third, it's just a handful, if that really drive most of the returns. And so ultimately, venture investing is just hopefully within a portfolio of 25 to 30 companies in a fund, like hit 2 or 3 outliers that do incredibly well, right? And so we're not in for the steady eddy, linearly growing businesses. We hope to kind of find entrepreneurs and opportunities that scale tremendously over a short period of time, right? And become these outliers.
Got it. Next one. If you could only ask a founder one question during a pitch session to determine if their marketplace actually has product market fit, what would you ask them?
What are the hot spots on your marketplace? Like where does it really work? And so that's really to the core of, do they understand, does this founder understand what kind of how to match, how to think around demand and supply and where it really works on the marketplace?
Yeah. Search for the hot spots. And from all the marketplaces you've invested in, what are the most unique ways you've seen companies crack the chicken or the egg problem? Do any specific stories come to mind?
Yeah, I mean, I think the general principle for me is like figuring out where the people that are interested in your marketplace are hanging out, right? And leveraging these platforms where they hang out, right? And so it could be offline, it could be online. Like think about, I mean, Etsy was very much built around handmade, and they literally went to all of the existing handmade meetups and kind of markets, et cetera, to really acquire sellers. Other people have done fantastically well looking at Twitter, right? And saying like, oh, there's an area where all of the sellers and suppliers are hanging out on Twitter, but they don't have a really good solution, right? And so kind of Greg's List, like leveraging Greg's List was obviously a big opportunity for Airbnb to really leverage their inventory. So you just have to think about most of these markets, right? They usually have already emerged. The suppliers are already there, right? It's not that you're creating a completely new market. What you're creating is kind of more liquidity in a condensed way on a separate product, right? And so thinking about where are buyers and sellers of that marketplace you're trying to create, right, are hanging out right now, and how do you get them over, right? And so I think it's generally very hard to create a marketplace for a behavior that doesn't really exist. Most of these behaviors already exist, right? And you're just providing a better outlet for buyers and sellers to meet, right? And so just think about ways how to find these buyers and sellers in the most efficient ways, and on what platform do you already find them?
It's kind of like that quote that the future is here, just not evenly distributed. I think that's what marketplaces are trying to do.
Exactly. Agreed.
Boris, this has been an awesome jam session. I appreciate you coming on. If people out there are interested in marketplaces, maybe they're a founder, maybe they're a CFO like me who's trying to get smarter, where can they find you?
Yeah, I mean, online, version1ventures.vc is our website. Alternatively, myself on Twitter, Wertz, BWERTZ. on Twitter or LinkedIn, Boris Wertz, just look me up. So these are a bunch of the channels how to get to me.
Thanks for dropping all these knowledge bombs. It's been really fun.
Perfect. Thanks for having me.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.